Forex might sound complicated, and it can be, but put simply, it's short for foreign exchange. It's a way of trading worldwide currencies to make money, or to lose money, depending on your experience, luck, and how much you have to invest. The whole system works on the principle of relative value. After all, how much is anything worth? What someone is willing to pay for it. A car might be a piece of junk, but one man's trash is another man's treasure. You can measure the value of money by what people will exchange for it and by how much of it there is. In this case, different kinds of money, all the way from the Afghani to the zloty. Let's take a look at how Forex works and how to make money from it. Foreign exchange is the world's largest form of exchange, trading around $4 trillion every day. But what exactly is it, and how does it work? Think of it this way: when you go on holiday, you're essentially trading in Forex. That's because the aim of Forex is that you want to buy a currency at one price and sell it at a higher price. The difference between what we do on vacation and what traders do in the market is that they're actively chasing profit, whereas if you want to catch some sun on a beach, you're most likely just looking to avoid a loss. For example, if the price of one British pound could be measured as, say, $1.50 the exchange rate between the two currencies is $1.50 exactly. If we apply this to Forex, this would be shown as a price of 1.5000 for the Forex pair GBP USD. We'll get into pairs in a bit more detail later on in the video. But where did Forex come from? What we know today as the modern Forex market was formed after the Bretton Woods system of currency exchange went under in 1971, and the currency rates of most larger nations became free-flowing. The flowing rate system is made possible by the market-making activities of several major global banks, and we all know what happens when this goes wrong. If you don't, ask anyone who lived through 2007. This system is collectively known as the interbank market, and it's a decentralized market that allows trading 24 hours a day and 7 days a week. Since the internet has come along, web trading systems have increased the speed and quantity of foreign trades daily, which has helped retail traders access the Forex market through regulated brokers. You'll often hear a term known as a Forex pair. This isn't a couple that have struck up a relationship on their mutual love of foreign currency. No. These are two currencies grouped into pairs to show the exchange rate between the two. Each currency is represented by 3 letters. Some of the most common Forex pairs are EUR USD, USD JPY, GBP USD, and USD CHF. These are called major pairs. You might also hear the term cross rates. These are pairs that don't include the influential US dollar, like EUR GBP, EUR JPY, and EUR CHF. That's not to say other currencies can't be traded. The less common ones included in pairs are called minor currencies or exotics. Example of these are the Turkish lira, TRY, and South African rand, ZAR, or the Norwegian kroner, NOK. Just like other trades that can be made in the market, there's what's known as a spread, which put simply is a bid price at which you can sell, aka the lower end of the spread, and an offer price at which you can buy, the higher end of the spread. Between these two is your profit, or of course, your loss. It's important to make note of the way round you're trading the two currencies. When you're buying, the spread always shows the price for buying the first currency of the pair, which is also called the base currency, with the second known as the quote currency. When selling, the spread gives you the price for selling the first currency for the second. So using an example, an offer price of 1.3000 for EUR USD means that it will cost you $1.30 to buy €1. In this case, if you wanted to make money, you would buy the price of the euro against the dollar, thinking that it's going to rise, which means that you think you will later be able to sell your €1 for more than $1.30. You can also have a bid price for 1.3000 for EUR USD, which means that you can sell €1 for $1.30. If you think the price of the euro is going to fall against a dollar, you can buy back your €1 for less than the $1.30 you originally paid for it. The other thing you might hear when it comes to Forex is pips. This comes from when Forex pairs were quoted to 4 decimal places, or 2 for the pairs with yen. A pip used to be the smallest possible movement you could get for a price, or the movement from the 4th decimal place. So for example, from 1.2112 to 1.2113, or from 0.8944 to 0.8945. These days, pairs are often quoted to an extra decimal place, but a pip is still linked to a single increment in the 4th decimal, or second for JPY pairs. Because of this 5th decimal place, you can also now have fractions of a pip. For example, a quote of 1.4011 to 1.54018 would be a spread of 0.7 pips. Put simply, it's a measurement to show movement of the exchange rate. When it comes to the actual trading part, this involves buying and selling currency pairs in an effort to hedge or speculate. If you were to trade, This involves opening a brokerage account, funding it, and then trading it. Once this is done, if you thought that the US dollar would rise compared to, say, the Japanese yen, you could buy the US dollar and sell the yen. But if you thought the euro would decline against the US dollar, you could sell the EUR USD by opening a sell position for one lot of that pair. Lots are just a number of units of those currencies. There are standard, mini, micro, and nano lots, which are made up of 100,000, 10,000, 1,000, and 100 currency units respectively. Traders are taking bets on small fluctuations in exchange rates, which are measured in the pips that we mentioned earlier. That's why Forex favors active traders and not so much those that are hoping to fall asleep and wake up with a big bag of cash under their pillow. For active traders, the Forex market is the one with the most liquidity, so easiest to convert cash without an impact to their assets. Other reasons why it's a paradise for active traders is the fact that commissions are often zero and bid-ask spreads are near zero. Also, there's no need to wait for opportunities to make money with Forex. There's always an opportunity for increasing currency somewhere, you just need to find it. And although the world of currency conversion is a risky one, it's not as risky as stocks. Currencies are generally less volatile than stocks, and the low return for passive investment with the Forex market means that the chances are the investment paid off due to skill rather than luck, meaning that if you can make money in Forex, you can do it anywhere. But on the flip side, if you're playing the long game and you want to sit on your investment, then Forex is not the place to do it. Passive investors rarely make money in this market. This is because returns are low, just like with money markets. The benefit of low trading costs seen with active traders is pretty much useless to a passive viewer, because they're not trading enough to see the benefit. Essentially, if you're going to trade Forex, then you need to be trading Forex. A lot. In terms of risk, currency markets are constantly fluctuating, driven by a wide range of factors: macroeconomic indicators, geopolitical events, market sentiment, and others. If you've lived over the past few years, you can see how difficult it is to predict the world. This volatility gives you the opportunity to make profits from Forex trading, but it can leave you in a hole if you're not careful. If you're happy with the risks involved, this kind of trading gives you a wide range of opportunities with all kinds of pairs traded 24 hours a day. Online trading makes this market really easy to get into, and you can tailor your trading to your own style, aims, and schedule. Forex can also suit a variety of trading strategies, both speculative and defensive, and can be backed up by different types of analysis. For example, you could base your Forex trading decisions upon the monetary policy decisions of central banks, or instead on your technical analysis of price patterns on your Forex trading charts. It's not necessarily for the faint-hearted, but if you know what you're doing and have a good active strategy, then Forex might be worth looking into.